Hello and welcome to this session in which we would look at the CPA exam simulation or an exercise that you might see in an intermediate accounting course that's going to help you also prepare for the CPA exam. Specifically, we're going to be targeting Treasury Stock. If you don't know what Treasury Stock, make sure you are comfortable with this topic because you are expected to know what is Treasury Stock. And Treasury Stock, simply put, is when the company buys back its own stock. When they have extra cash on hand, what they will do, they might decide to take that cash and buy back their stock. And what they do sometime after they purchase their own stocks, they go back and they resell the stocks. And this is what we will discuss in this session. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Adam Company has outstanding 80,000 shares of $10 par value stocks. So the par value for this company is $10, which had been issued at $60 per share. Fair enough. Review the following transaction and determine their effect, whether it's an increase, decrease, no effect on the classes of the accounts below. So simply put, we have a series of transactions and we want to know what's their effect on assets, liabilities, paid-in capital, retained earning, or net income. Now on the CPA exam, you might have a drop-down list and it might say no effect, decrease, or increase, and you would select. But we're going to do the same thing here, but I'm just going to tell you whether it's an increase or a decrease. First thing is, we are told that 80,000 shares were issued at $60. Let me just go ahead and show you the initial journal entry. Initial means when they initially sold the shares. So they sold 80,000 shares at $60. So initially the company debited cash, 4.8 million. They credited common stock. How much will you credit common stock? And you need to know this by heart. You credit the common stock number of shares, which is 80,000 shares, times the par value. You credit common stock $80,000. Why? It's the number of shares times $10 the par value, and anything left you credit an account called APIC common stock, additional paid-in capital. Simply put, APIC common stock is 4.8 million minus 80,000 in common stock. What's left is additional paid-in capital, 4,720,000. So this is when the stock was issued. We're not being asked here about this, but let's assume we are. What happened in this transaction? I want you to understand this because this is going to help you understand the subsequent accounts. Assets went up, liabilities was not affected, stockholders' equity went up, which is common stock, and paid-in capital went up. Retained earning was not affected, net income was not affected. So just FYI, but this is not one of the transactions that you need to do. But I'm going to keep those up there because I want to see the opposite of when we buy back our own stock. What the company did next is they purchased 5,000 shares at $90. So the company decided to do what? Take some cash that they have and purchase 5,000 of their own shares, and they paid $90 for it. What we're going to do, we're going to debit an account called Treasury Stock. I'm going to abbreviate STS. Let me just write it for the first time. We're going to debit Treasury Stock 450,000, and we are going to credit cash 450,000. Okay, so this entry is the opposite of this entry. In other words, we sold 4.8 million worth of shares. Now we took $450,000 and we purchased back some of the stocks. We debit Treasury Stock, we credit cash. Now, what's the effect on assets? Well, obviously cash went down. So the first transaction, cash went down, liabilities is not affected. Treasury Stock is a contra-equity, therefore stockholders' equity went down. Paid-in capital was not affected. Retained earning was not affected, and net income is not affected. So I hope you see that buying back treasury stock has the opposite effect of issuing stocks. Great. Resold 2,000 shares of treasury stock at 98. Remember, we purchased 5,000. Now we resold some of them, and we resold them at 98. So if we take 2,000 shares times $98, we received in cash 196. We are reissuing the shares that we purchased. So we're not issuing new common stock. We are getting rid of the treasury stock. Therefore, we are going to credit treasury stock, and this is the treasury stock account. How much do we credit treasury stock? We're going to be using, for the sake of this example, the cost method. We have the cost method, we have the par value method. I do have the par value covered in a separate recording, but the most common method is the cost method. So when you're using the cost method, what you do is you take the number of shares you are reselling, which is 2,000 shares, and you remove them at cost. What's the cost? The cost of them is $90. You will take 2,000 shares times $90, and you credit treasury stock 180,000. Great. Now we have a problem. A problem in a sense that we have a credit hanging of 16,000. Well, if we have a credit hanging of 16,000, what do we credit? Well, here's what happened. We purchased shares at 90, our own shares, to be specific, stock shares of our company. Then we resold them at 98. It means we made $8 in quote profit. We are $8 better off. Why? Because we purchased them at 90, sold them at 98. What do we credit if we have a gain? Listen to me carefully. You don't credit any gain or increase net income. When you sell your own treasury stock and you make, in quote, a profit, you credit an account called paid in capital treasury stock. So you credit an equity account. This is an equity account. So let's go back and see what happened here. We sold and we received cash. Asset went up. No liabilities. Stockholders' equity, paid in capital. Well, simply put, as we reduce treasury stock, stockholders' equity goes up, and paid in capital, treasury stock, paid in capital went up. We could have paid in capital common stock. We could have paid in capital treasury stock. This is treasury stock. Retained earning was not affected, and net income is not affected. Now, what I want you to do is I want you to keep track of this account, paid in capital treasury stock. I'm going to create a T account here. I'm going to put the 16,000 here, paid in capital treasury stock, because we need it. Now, we resold 500 shares of the treasury stock at 80. So we resold 500 additional shares. So if we take 500 shares times $80 in cash, we received $40,000. That's great. Now we need to remove treasury stock. Treasury stock is removed at cost. We sold 500 shares. The cost is $90. We remove treasury stock at 45,000. Now what happened is this. We purchased our own shares at 90. We resold them at 10. We are not better off. We are worse off. How much worse off? $10 per share worse off for those 500 shares. It means here, first of all, from a journal entry perspective, we have a hanging debit of 5,000. What do we debit for that 5,000? That's the question. Well, here's the answer. Here's what you do when you have a loss. I'm going to change colors. Here's what you do. The first thing you ask yourself, do I have paid in capital treasury stock? Do I have an account, a balance under this account? Because this is where I booked my, I'm going to put it in quote, my gain. If the answer is yes, I'm going to use this 5,000, see if that account will absorb it. And guess what? I do have enough paid in capital treasury stock. I have 16. Therefore, I'm going to debit paid in capital treasury stock. So the debit is paid in capital treasury stock. And this is what I would debit. And what I have left is 9,000 in paid in capital treasury stock. Let me just show you what happened here. Assets went up. We have more cash. Liabilities was not affected. Treasury stock, stockholders' equity went up because treasury stock went down, and paid in capital went down because we debited paid in capital treasury stock. No effect on retained earning, no effect on net income. Now I'm going to change the scenario a little. And let's assume for the sake of this illustration, those last, I'm going to change colors again. Those last 500 shares, I'm going to delete the blue, kind of because I'm going to change the scenario. So those last 500 shares were sold at $20. Well, if we sold those 500 shares at the stock price went down substantially, so we're going to debit cash $10,000. We would still credit treasury stock 45. Now the difference between 45,000 and $10,000 is a quote a loss of 35. Let me put the loss here. I'm going to put in quote a loss of 35,000. The question is, what do we have to do with this loss? Once again, once we have a loss, the first thing we look at is, do we have a paid-in capital treasury stock? And the answer is yes. We have 16,000 of paid-in capital treasury stock. Great. So of the 35,000, 16,000 will be absorbed by paid-in capital treasury stock, 16,000. And once we debit paid-in capital treasury stock 16,000, paid-in capital treasury stock would go down to zero. But that did not solve the problem because we still have a $19,000 debit. What do we debit? Well, here we go. When we no longer have paid-in capital treasury stock and we still have losses to absorb, we are going to debit retained earnings. We're going to debit retained earnings. Therefore, we do reduce retained earnings. So if we want to show the effect of this transaction, assuming we sold them at $10, asset went up, cash went up, liabilities was not affected, stockholders equity overall went up because treasury stock went down. It's a contra-equity. Stockholders equity went up in the sense that treasury stock went down. Paid-in capital went down because we debited paid-in capital treasury stock. Retained earning went down and net income was not affected. So the first thing I want you to notice, when you buy and sell your own stock, there's no effect on net income. That's not the first thing. And there's no effect on liabilities when you buy and sell your own stock. Great. So this is an example that illustrates the concept of treasury stock, a topic that you need to be comfortable with, whether you are an accounting student, a CPA candidate, CMA candidate. Treasury stock will be tested. Again, as I told you, there's also the PAR method of treasury stock. It's covered in a separate recording. What should you do now? Go to Farhat Lectures, look at additional resources that's going to help you, whether you are a CPA exam candidate, CMA candidate, accounting student, finance student. Invest in yourself. Good luck. Farhat is always here to help.